Bismillahirrahmanirrahim. Assalamu alaikum all students. Hope you all will be doing well. As in the previous lecture of financial plan, we introduced to you the different concepts in the financial plan of any startup or any business, whether that is an established business like sole proprietorship, partnership, or public limited company, or it is a new business, a new beginning. In both cases, you need to plan for the money requirement of your business, because the lifeblood of any business is the money, the liquidity, the paying of your different liabilities, all these, the loan taken from banks or any other friends even, and when to pay back them. All these things should be very carefully and analytically planned. Here again, students, the rising jet, like promising startup, see a nice sun behind and a jet flying in the forward direction. So if your business is promising, you have targeted the right customers, and you have made a good financial plan and its different aspects, then it will generate revenue for you, and from the revenue you will deduct different expenses and you will have a net profit, and you can calculate the break-even point from your sales and the revenue it generates. The break-even point, i.e. the number of units sold by the business. At that point, neither the business is getting profit at that point, or that amount of sales sold by the business, or neither it is at loss. So this is very important to calculate the break-even analysis for any business. Now coming guys to the next slide, again a jet moving in forward direction. A nice plan, financial plan, can be a smooth a smooth movement in the forward direction, like this jet is flying in the air. Now another example where we see a crash of a plan. So if you have not planned your financial before starting the business, and the assumptions were not based on solid data, primary and secondary data, and there were many gaps between what you have planned and what actually occurs when you start the business, then you may face liquidity problems, like not able to pay the supplies on time, paying your debts on time, or salaries or electricity bills, all these things, and it can jeopardize the very existence of the business, like we see in this picture. So be like the first two plans, not this third plan. Okay, now coming to the actual business, boys, the pro forma cash flow, that how much cash will come to you, how much will be going out, and what will be your actual liquidity at any point, projected cash available, calculated from projected cash accumulations, the cash coming into the business either from sales, or you sold some of your assets, or you take some loan, or you launch some new shares in the market. All these are different aspects of the capital, or the money coming into the business, cash coming into the business, minus projected cash disbursements at any point, at any month of the year. When you minus them from the cash coming and cash going, the difference will be the cash. Either it will be positive or it will be negative. So you should be very careful and very smart in dealing with your cash management of the business, because the cash is very important for any business. Without timely payments to your vendors, to your suppliers, to paying your bills and other things, you will be out of money, or sometimes you will be unable to pay them. So then you technically will be in a great problem. It can even you can even stop your business operations due to inability of your cash position. Otherwise you will have plenty of inventory, plenty of accounts receivables, money people have to give to you, and very handsome assets, but there is no cash, so you will be in hot water. So cash management is very important, boys. Be careful in handling cash of your new business, even at your personal levels. Sales may not be regarded as cash. As I have told you, sales are the product services you sold. The money, the sales may be on cash, like McDonald's, KFC and other products, but it may be on credit. When it is on credit, it will take time. Use of profits as measure of success may be deceiving if there is significant negative cash flow. Negative cash flow is a very bad indicator for any business. As I have told you, should be very smart cash manager, the cash management expert. If you are not, you should hire one. Cash flow can be projected using the indirect methods. Now, statement of cash flow, the indirect method. Cash flow from different operations. For example, cash flow from operations activities, the things which are plus it is cash coming into the business, the things which minus that is cash going out. Net income and adjustment to net income. What are the adjustment? Non-cash in non-operating items plus depreciation and amortization. That is cash inflow, because you purchased a thing, but now you are taking depreciation amount out of your operating income, in taking it aside in the account of business or your account. Cash provided by changes in current assets are liabilities. Increase or decrease in accounts receivables. Accounts receivable, if increase to certain limit, is a good thing. That means people have to pay you. But if it is more than certain limit, then keep remember that there are chances that the bad paid cashes may hamper your business. Net cash is provided by operating activities. Cash flow from other activities like capital expenditures, payment of debt, dividend, all these are minuses, because cash is going out. Sale of stock, sales sold to the investor, cash coming in into the business. Pro forma cash flow Entrepreneur must make monthly projections of cash. So if disbursements are greater than receipts, entrepreneur must either borrow funds or have cash in bank. As I've told you, you should not be out of cash. Large positive cash flows need to be invested wisely in profitable projects, profitable business. So money come into your business. Determining the exact monthly receipts and disbursements is a bit difficult and also very tricky, but you can calculate near to the exact figures. Pro forma cash flow is based on best estimates. Again, receipts of sale, other costs deducted, and the net cash flow with you, beginning balance out the cash outflows, then the ending balance, the cash in your business account. Again, in the February, another money going out of the business and coming in a certain cash flow you are carrying on along the months till November and December. In December, you have a positive cash flow from the operations. Pro forma balance sheet. Balance sheet is the financial position of any business entity at a specific time. On the other hand, the pro forma income statement and cash flow statement is either the cash position or the financial position of a business entity over a period of time. That may be 6 months, that may be 1 year, that may be 3 months. It is a picture of the business at a certain moment in time, as I have told you, and does not cover a period of time. Consists of assets, liabilities, and owner's equity. If you have studied financial management or accounting, you will have gone through the basic fundamental equation of balance sheet, that assets is equal to liabilities plus owner's equity. Assets and liabilities are assets is equal to liabilities plus owner's equity. Here we have an example of a real-time business firm in its balance sheet. See both sides of the balance sheet. You will find that the total assets and liabilities. Here is the total assets, $152.3 million is equal to total assets and liability. Here is the figure. Both sides are equal. If they are not equal, that means there are some issues in your accounting system. You have to sort out where is the mistake. Now coming to most important aspect of any financial plan is the break-even. The break-even is the point neither you are making any loss or profit. As from a definition it is very clear. Volume of sales, whether the business venture neither makes a profit nor incur a loss. The break-even, my formula is total fixed cost is equal to selling price per unit minus variable cost per unit. It is called basically marginal cost, and when you divide the TFC with the marginal contribution, marginal cost, it gives you the the number of units when at which the business the startup will be at break-even point. Major weaknesses in calculating the break-even lies in determining if the cost is fixed or variable. Fixed costs are those costs which you must incur whether you are producing a single unit of your product or service, or you are not producing that. On the other hand, variable cost can only incur when your business start producing services and products. Here is the graphical illustration of the break-even of a business. You see the number of units on the horizontal line: 100 units, 200 units, 300 units, plus round about 320 units is the break-even point. On the other hand, total revenue, how much total revenue it will generate, it is on the vertical line. Almost revenue between 1200 to 1300. In between the two figures will be the revenue when it is divided. When that revenue is generated and more than 300, i.e. 320 roundabout approximately units of goods are sold. For example, if it's a car manufacturing company, that means this number of vehicles are sold and this number of revenue generated due to the sale of those vehicles. So it will give you the break-even point. These are the fixed costs, vertical line here. This you will incur whether you are whether you are producing any unit in your business operation or not. And above it, when you produce some products or services, your total cost will increase as the variable and fixed cost both will increase, and it will produce some revenue in the form of money. I hope you are moving with me, students. Now, pro forma sources and application of funds. What sources are coming into the business, from where they are coming, and what are the applications where those funds will be used. Sources are operations, new investments, and long-term borrowing, sale of assets. All these, if you, for example, you have a house and you sold it, that is a source of cash. Long-term borrowing, money borrowed from bank and paying in the future. New investments, you have made some investment in the stock market and give you dividend. Operations, your operations starting to generate money. Uses are increase in assets. You purchase another car, you purchased another home. Retire loan. Long-term liabilities, pay your liabilities, that is application of the cash. Reduce owners, stockholders equity, pay dividend. Dividend is the profit given to each shareholders in public limited company, corporation or multinational companies. I hope, students, you understand the topic and your questions and will be welcomed in the live session, and that will generate a good discussion. Thank you. Khuda Hafiz. Stay safe and blessed.